Hey everyone, welcome back to the channel. Something unusual happened in markets at the end of January, and it wasn't triggered by a new model, a benchmark chart, or a flashy demo. It came from a product release that, on the surface, looked almost boring. No proprietary data set, no fine-tuned vertical model, just a set of open-source plugins, and yet, within hours, roughly $285 billion in software market value was gone. This video is about how Anthropic managed to do that, why investors panicked, and what it quietly revealed about where the software industry is actually heading. On Friday, January 30th, Anthropic released 11 open-source plugins for its new agentic AI assistant called Claude Cowork. Claude Cowork itself had only launched earlier in the month. Think of it as Claude Code, Anthropic's developer-focused coding assistant, but redesigned for non-technical professionals. It can read files, organize folders, draft documents, and carry out multi-step tasks with explicit user consent. On its own, that wasn't market-moving. What changed everything were the plugins. These plugins let companies specify exactly how work should be done, which tools and data sources Claude can pull from, and which workflows it can automate. Anthropic open-sourced starter plugins for productivity, sales, marketing, finance, data analysis, customer support, product management, biology research, and legal work. Most of those barely registered with investors. The legal plugin did. That single plugin automates contract review, NDA triage, compliance checks, and legal briefings. Anthropic went out of its way to say the tool does not provide legal advice and that all outputs must be reviewed by licensed attorneys. That disclaimer didn't matter. Markets reacted instantly. Thomson Reuters dropped more than 15% in a single session. RELX, which owns LexisNexis, fell 14%. LegalZoom was hit for nearly 20%. A Goldman Sachs basket tracking U.S. software stocks posted its worst single-day decline since April's tariff-driven sell-off. The Nasdaq fell 1.4%. The shockwaves didn't stop there. Infosys ADRs dropped 5.5%. Wipro fell nearly 5%, and Indian IT stocks broadly sold off. By the end of the day, analysts were calling it a SaaSpocalypse. Here's the part that confused a lot of people. The legal plugin isn't some magical legal brain. There's no proprietary model fine-tuned on case law. There's no specialized legal reasoning engine. It's Claude being Claude, guided by structured prompts and workflow instructions. So why the panic? Because this wasn't about intelligence, it was about control. For years, AI companies sold models, software companies built workflows. That boundary kept everyone comfortable. Claude was an API. Companies like Thomson Reuters could build products on top of it. In fact, Thomson Reuters literally runs its co-counsel product on OpenAI models. Anthropic crossed that boundary. By publishing ready-made vertical workflows, Anthropic moved from selling the model to owning the workflow. When that happens, the platform stops being infrastructure and becomes a competitor. Investors immediately reprice that risk. Jefferies analyst Jeffrey Favuza described the trading as very much get-me-out style selling. Jefferies also noted that enterprise customers now account for roughly 80% of Anthropic's business, and that OpenAI appears to be losing ground in the corporate market to Claude. The sell-off spread far beyond legal tech. DocuSign fell 11%, Salesforce dropped nearly 7%, Adobe slid 7%, ServiceNow declined 7%, Blue Owl Capital Corp fell 13%, marking its 9th consecutive daily decline. Private credit firms exposed to software loans got dragged down. Apollo, KKR, Ares, and Blackstone all dropped. In Europe, RELX fell again, Wolters Kluwer declined, and London Stock Exchange Group slid as much as 6.9%, extending a prior near 13% drop. SAP fell nearly 4%. Advertising firms like Publicis and WPP hit new lows. In Japan, Nomura Research plunged 7.6% to a 52-week low, with Fujitsu and NEC also sliding. India's Nifty IT index closed down 5.8%. Meanwhile, the broader S&P 500 hit an all-time high. That divergence matters. The S&P 500 Software and Services Index has now fallen nearly 13% over 5 straight sessions and is down 26% from its October peak. Only 71% of software companies have beaten revenue expectations this earnings season, compared with 85% across the broader tech sector. This sell-off didn't happen in isolation. It landed on top of existing anxiety about AI disruption, slowing enterprise growth, and stretched valuations. Regulators including the IMF and the Bank of England have already warned about a potential AI-driven market bubble. Some voices pushed back hard. NVIDIA CEO Jensen Huang called the reaction the most illogical thing in the world. At a Cisco event, he argued that AI will use existing software tools, not replace them. Would you use a screwdriver or invent a new screwdriver? Google CEO Sundar Pichai echoed that view on his earnings call, saying companies that seize the moment with AI will find opportunity, not obsolescence. Others were less convinced. Mark Murphy, head of U.S. enterprise software research at J.P. Morgan, said it felt like an illogical leap to assume Claude Cowork plugins meant companies would suddenly rebuild every layer of mission-critical software. Ben Berenger from Quilter Cheviot said AI agents aren't yet capable of destroying software companies, especially given security and data ownership concerns. Still, he warned volatility is likely to continue because during periods like this, markets shoot first and ask questions later. J.P. Morgan analyst Toby Ogg put it more bluntly. He said software stocks aren't just guilty until proven innocent anymore, they're being sentenced before trial, and that's the key psychological shift. This wasn't a rational model-by-model assessment of replacement risk, it was a scramble to de-risk portfolios in an environment where AI progress is muddying business prospects beyond traditional 3 to 5 year forecasts. Anthropic's move also hit a nerve because of who it is. Anthropic builds its own models. Startups like Harvey AI, valued at $5 billion, and Legora, valued at $1.8 billion, rely on models from companies like Anthropic. That means the model provider can potentially disrupt not just legacy legal platforms, but also the startups trying to disrupt them. Investors took that seriously, because Anthropic's growth has been anything but theoretical. Claude Code reached $1 billion in annualized recurring revenue by November, just months after launching in May. Anthropic is reportedly raising $20 billion at a $350 billion valuation, up from $61.5 billion in March 2025. Claude Cowork launched on January 12. The plugins dropped less than 3 weeks later. That iteration speed is almost unheard of in enterprise software. This is where the comparison to Amazon starts making sense. Early AI startups are under pressure to justify massive valuations and infrastructure spending. Moving into high-value enterprise workflows is one of the few ways to do that. It's the same pattern Amazon followed, starting with books and expanding outward into retail, cloud, and logistics. But there's also skepticism baked in. Many analysts argue that AI startups lack the specialized proprietary data that incumbents rely on. Others point out that security, compliance, and governance remain real barriers. Surveys show 53% of IT leaders expect AI to enable workforce reductions, but many still believe AI will enhance productivity rather than replace entire systems. What made this moment different is that Anthropic didn't promise future disruption. It shipped something that already does work people pay software companies for. That forced investors to confront a harder question. If agentic AI can automate routine, billable workflows with prompts and connectors, what exactly is the moat? Is it the model, the data, the interface, or is it simply time and trust, both of which can erode faster than expected? Stephen Yu, CIO of Blue Whale Growth Fund, summed it up when he said this year will define who are AI winners and who are victims. Until the dust settles, standing in the way of AI is a dangerous place to be. None of this means software is dead. Even the loudest skeptics admit that AI will likely coexist with existing tools for years. But the market just signaled that workflow ownership is now the battlefield, not raw intelligence. Anthropic didn't need a breakthrough. It didn't need a new model. It didn't need better benchmarks. It just needed to show what Claude could already do and hit publish. That's what spooked the market. Thanks for watching. This is AI Tides, and I'll see you in the next one.